The US Fed hiked its interest rate by 0.75% last week, the highest increase since 1994, and 0.5% in May. That brings interest rates to a range between 1.5 to 1.75%, and more rate hikes are expected in the coming months. Following the recent rate hikes, analysts are closely tracking the impact this will have on emerging markets and their economies. The primary challenge of higher interest rates is that they weaken the value of other currencies against the dollar, making it more expensive to serve existing debt payments and often triggering an outflow of capital investment from emerging markets. Middle and low-income countries are currently especially vulnerable to negative spillovers caused by the tightening of US monetary policy. With sharp increases in sovereign and private debts due to the pandemic response, these countries face more difficult recoveries and, in the worst cases, even economic crisis from the jump in interest rates. There are several panel studies which demonstrate that the relationship between monetary policy tightening by the Fed and negative economic spillovers is not limited to a few dramatic cases, but is a systemic, long-term, and serious problem that needs to be addressed. A panel study of 50 economies from 1965 to 2016 found that a monetary policy shock from the Fed of 100 basis points caused a decline in output of 0.5% in advanced economies and 0.8% in developing countries after 3 years. Another interesting study, which used 27 developing countries from 1973 to 2014 and looked at the role of US monetary policy as a determinant of crisis. The results are illustrative of the strong impact US monetary policy can have on developing countries. Therefore, the Fed should be cautious in its rate hikes. It could not only harm its domestic economy by pushing it into a recession, but also economic crisis in middle and low-income countries. Interest rate hikes are inappropriate response to inflation spikes that are caused by supply chain disruptions or major shifts in the composition of demand, both of which are seen as major causes of rising inflation over the past year domestically. If interest rate rises cannot be avoided, urgent action is needed to reduce developing countries' vulnerabilities. There are a number of reforms that could be made to the international financial system to reduce systemic risk and make debt crises easier to manage, but these will take time and political action. A faster solution would be to shore up countries' international reserves through an SDR allocation by the IMF. This has the advantage that it is tried and tested and could be implemented almost immediately.